I'm looking at the four majors, which are holding on to positive territory. A nice run-up in the overnight session after Fed Chair Jerome Powell's comments yesterday and the Fed decision, and ahead of some data this morning. Jobless claims just came in kind of mixed, but what stood out to me was the non-farm productivity number, the unit labor cost, because productivity came in significantly higher than expected, and the unit labor cost came in well below anticipated levels. We got just the person to help us break it all down this morning. Scott Bauer joins us, the CEO of Prosper Trading Academy. Scott, I want to get into the jobless claims numbers in a minute, which, as mentioned, seemed a bit mixed. They were a little bit higher than expected this week, but last week's got revised lower. What stood out to me was this non-farm productivity and the unit labor costs.
Yeah, I agree, Ben. And you know, that's a number, especially on the labor side there, the labor cost side, that the Fed wants to see. Definitely. But the biggie will be tomorrow. The biggie will be tomorrow. But that number certainly plays into what Powell was saying yesterday. And, you know, the market is going to like this, right? I mean, this is what the Fed is looking for, but they need to see it on a bigger scale.
Yeah, I'd agree. The market's going to like this. We're actually just a couple points higher than we were as headed into it in terms of the S&Ps, right around 42.90. We were at 42.88. I'm looking at the bonds. We were trading 111.28 headed into that. A couple ticks up there, so rates coming off just by a few ticks. The dollar is right around 106, and we are currently trading, well, as we are, where's that dollar again? Yeah, currently trading, as you'd expect to see, a little bit lower here with the bonds a little bit lower. Treasuries yields coming off here. Talk to me, because looking at this jobless claims number at 217,000, I mean, the market's going to like this one too, right, Scott? In many ways, this is kind of that sweet spot that the Fed's been looking for. We saw that one tick below 200,000, which raised some concerns in terms of things heating up. But now we're back above that level, and this is very comfortably in the zone they'd like it to be.
It is definitely in the zone, and as long as that number was with a two handle first, and then even slightly higher than what the estimates were, which is what this is. Yeah, that's right in the sweet spot. Again, though, Ben, I think tomorrow is going to be the big one. But, you know, look at the data, look at the recent data, and that is what caused the Fed to stand pat. That is what caused, you know, I'm not going to say that Powell was dovish. He definitely wasn't dovish, but let's say he wasn't as hawkish as he was last time. And I think that's what, you know, the market is really sinking its teeth into, and why we saw the big rally yesterday and a continuation today.
Yeah, I'd have to agree. We were focused on that. Rates down, right? Dollar down, all in reaction to Fed, Powell. Scott, I mean, we've got the 10-year below the 20-day moving average for the first time in 2 months.
Absolutely. And, you know, it seems that it was just, you know, overnight or just a short while ago, we were staring at 5% on that. Now we've got it, you know, hovering 480-ish or so. You know, that's all signs that the Fed wants to see. But again, it's hard to stay optimistic in this marketplace. But I guess one has to be. Tomorrow will really be a telltale sign, because then after tomorrow, yes, we do have the rest of earnings season to play out, but then we have 6 weeks until the next Fed meeting, where this last one was a real short cycle. It was really only 4 weeks, so we have 6 weeks, and that'll give the Fed a lot of time to look at more data, including what the consumer might be doing heading into the holiday season.
You know, Scott, throughout this move up we've seen in rates, I've been very skeptical at the pullbacks we've seen, similar to what's playing out here today, right? They've been short-lived, and throughout this trend higher, and all trends in theory, right? The move counter trend is limited in terms of follow through. That's what makes the trend to the upside. If we can pull this chart here, because it's still very well defined to the upside, could be that we're starting to consolidate at this upper level here. Wouldn't surprise me to see us bounce around 5% in the 30-year on the left, and around this 4.8 level, call it, in the 10-year on the right. But Scott, getting back to the Fed and a little bit more specifically, I'm kind of thinking and sort of feeling like they're leaning on this lag effect, right? The idea that tighter financial conditions are going to do some work for them. This move that we're looking at here in rates possibly did some work for them. And I think maybe they're right in some ways, because me as a prime example, here I am, I've got a 4 or 5-year-old car right now. I'm thinking about getting into a new one, yet I've got 0% financing and another year left to pay on this one. So it's 4 years into this one. And I'm thinking, why get into a new car at a 7 or 8% rate at this point and deal with the circumstance that my son just put himself in after buying a new car 2 months ago? I maybe, again, if rates were still at 0%, I'd have been in the showroom and I'd be driving a new car on the street right now in theory.
And that thought process is across the board, right? And that's why the Fed is saying, this is kind of doing the work for what they want to accomplish. And we're going to see that playing out over the next 6 months. And that's why I also, just made the comment that it'll be interesting what the Fed says about the consumer going into the holiday season. Is that next meeting is just a couple weeks before Christmas, because we're going to see if some of what you just talked about really does affect the consumer and how they are spending going into the holidays.
Yeah, well, if your mortgage rates are on the rise here, like we've seen others deal with, then ultimately that is going to impact your holiday spending in theory, in addition to some of the other pinches on some of that discretionary funds or spending that you have. Let's talk a little bit about how it's not just the Fed. You've got the pound in reaction to the UK and the Bank of England here today.
Yeah, they stalled their hikes again for a second time, and they sounded a little bit more aggressive, a little bit more hawkish than Powell did. But really, it's almost a copy of the landscape there. Looking for that 2% inflation target, which they're not anywhere close. In fact, they're at about 6.5% right now, so they're about triple what their target is. And it was really, though, the same sort of statement that I heard yesterday coming out of the Fed. But we know that it took a lot of these other central banks a long time to catch up to the aggressiveness of what the Fed was doing. The Fed was much more aggressive with their rates. So we saw that through the British pound. We saw that through the euro. And now I think we're starting to see that play out a little bit, where they may stay hawkish longer than the Fed does.
Well, we've got the pound, which is on the move higher here, back up into this 122-ish, 123 area. So something to watch here if this continues to regain composure, because, again, to your point here, we definitely saw the dollar strengthening with the euro and the pound weakening as the Fed was a bit more aggressive into last fall. Talk to us about, well, the other focus here this week being the yen and the Bank of Japan, some of the decisions this week. Yeah.
Yeah, well, we've seen the yen go to a 15-year low versus the euro. It's as low as it's been against the dollar in a year. And their new rhetoric, is somewhat of, I'm not going to say it's currency manipulation, it's not, but is somewhat of leaning towards, okay, we need to get some stability here. And that's why that new, 1% target is not a limit anymore, right? It's just a range, and they're trying to stabilize that a little bit because the yen has been so weak. Yeah,
we're going to continue to watch. That's been one of the more well-defined trends we've been watching. Scott, always appreciate you joining us. Thanks for sharing part of your Thursday with us here on the Schwab Network.
Thank you, Ben.
Scott Bauer, CEO of Prosper Trading Academy.